Late last week, this famed hedge fund manager, one who wields nearly $40 billion in assets under management, and he himself reportedly a five-fold fiat Federal Reserve note billionaire, Mr. Paul Tudor Jones told the world via this Bloomberg press release that he was going long Bitcoin on top of his famed bullishness for gold. His motivation? Unprecedented global fiat currency creation versus a finite supply of proven gold bullion and often outperforming Bitcoin. According to Jones, investors need to throw away the financial playbook of the past decade and return to monitoring old-school fundamental data, such as the aforementioned, now exploding, M1 fiat currency supplies around the world. On this channel, we recently shown you updates regarding the hardest M0 fiat Federal Reserve note or US dollar data in relation to our gold-silver price forecast long-term calculation video. Stick around to watch that video after we look at some of the potential long-range gold price projections that Paul Tudor Jones and his staff make. In this video today, we're going to delve into a bit about this man's past and present investing strategies, using his words to highlight some of his evergreen investing and trading thoughts. And importantly too, we'll cover some present day highlights and charts from the letter that he and his fellow co-writer issued to their clients called The Great Monetary Inflation. Hello, this is James Anderson on behalf of SD Bullion, and we're about to go deep into some macroeconomic thoughts and monetary aggregate charts provided by this billionaire, Paul Tudor Jones, one of the forefathers of the modern hedge fund industry. And to begin, here are a few minutes of clips from a PBS documentary shot over the years 1985 and 1987, which encapsulates a whiz Wall Street trader and his team working through the beginning financialization of the U.S. economy in the middle 1980s. He was one of many other still active investors who both correctly predicted and profited from the 1987 Black Monday crash, where the stock market fell by over 20% in one day. We'll leave a link to this one-hour documentary in the show notes, but here again are a few highlights so you can get a better sense of who this highly successful investor was then and is today.
Yes, there will be some type of a decline without a question in the next 10 to 20 months, and it will be earth-shaking, it will be saber-rattling, and it'll have Wall Street in a tizzy, and it will create headlines that will be that will dwarf anything that's happened at this point in time.
Paul Tudor Jones is a futures trader. He speculates on the future value of almost anything. It's been called an art, a science, a gambling game. It's a high-risk game for high rewards in an arena that is increasingly under scrutiny. Recent scandals have brought the Wall Street community into the glare of public and media attention, and the regulatory agencies are questioning the very existence of a certain kind of trading, stock index futures, at which Paul Jones has recently been one of the most successful players in America. Paul buys and sells futures in cotton, oil, dollars, Deutschmarks, bonds, precious metals, anything he thinks can turn a profit. Every rumor, every news item can be a warning or an opportunity. For example, this morning, the wires say OPEC is on the verge of a new agreement.
OPEC has basically come to an agreement whereby they're going to have a 7% production cut, and my whole feeling is that anytime that you try to get 13 people to agree to anything, and I have a chance to take a position on it, well, they're going to have to, wild horses couldn't keep me from betting against them succeeding in that. I'm selling the equivalent of about 4 tankers on the opening. You've heard nothing else on OPEC?
No.
I got you.
Thank you, Paul.
Yeah. What do you think of it, JJ? Is this a spot to nail it? I'd rather sell it down, though, than sell it
Betting
here.
that the agreement won't hold, Paul is selling oil futures as fast as he can, hoping that the other traders won't see what he's up to. Speed is everything.
Is 40 bid and a half? Offer 1,000. Offer 1,500 at 40. Offer 1,500 at a half. Show the size. Ask him how much he sold. Give me a number. Tell him more behind it. Do it. There's more behind it.
More behind it.
I can feel it. They're gonna get it. I'm gonna get it. Iraq just said something. What does Iraq say? That's great. They have an agreement between 13 people, but 2 of them said they won't agree, which happened to be 2 of the 5 biggest producers in the world. That was tough to figure out, wasn't it?
Paul is on the phone to an oil trader who's saying somebody's been selling a lot of oil. but he doesn't know who.
That was my buddy at probably, again, the second or third largest crude trading firm. And his guy said, man, these guys, they sold the hell out of it. And the people that he worked with don't know that it was, which is great. That's even better. I hope they think it's some wild as shit Arab who knows the whole agreement's getting ready to fall apart. The one thing that I am absolutely certain of as a trader, and you're talking to someone right now who is incredibly long the stock market, is that all of Wall Street right now, the investment community at large, basically is geared towards a Dow somewhere in the 2,600 to 3,200 range. And again, these are people that I think have track records that are impeccable. Let's assume that they are 100% wrong. If nothing else, there will be a point in time, unquestionably, when the market turns down, when all of them, when again the investment community almost at once will say, that may have been the top, or this was the top, and you're going to have all the people that are right now very comfortably invested, that are believing and feeding off the hope that the market will move higher, try to get out at the same time. When that happens, you know, it's going to be the famous Acapulco cliff dive. Just a question of how fast before we hit the bottom. First of all, you're talking about certainly 6 to 8 years of pain. It's a horrible thought. It's not one that I hope happens, and I hope I lose my ass, and I hope the Dow Jones goes to 5,000 and sticks, but that's not what I think is going to happen. And it just won't be. It'll be just like if you have an injury, it takes a while to work yourself back into great shape. And I think the long run benefits will be fantastic. I think the short run will be unpleasant. It'll be painful, and there'll be an enormous amount of general suffering for not just the U.S. populace, but on a worldwide basis. The other thing, I mean, I guess the flip side of the coin is that we've had an incredible 10 years.
Obviously, this is really easy to do with the benefit of hindsight, but we wonder if a younger Paul Tudor Jones would have believed us if we told him that the U.S. and global economy would be fiat financialized for another 3 decades running, and that 3,000 Dow target would require another zero recently before crashing as it did. Let's now move on to more present-day affairs regarding our main topics today. Last decade in the 2010s, as a growth speculation, Bitcoin effectively kicked every asset's butt known to mankind. Bitcoin began at a starting price of around 9 cents in 2009, peaking near 20K in 2018. There's never been as widely traded a homogeneous asset that has risen over 200,000 times in valuation multiples, peak to trough, in human history. Like gold, BTC is an emotional asset class that mixes a myriad of strong takes and feelings from all over the globe. But this is a video mainly about looking forward, not backwards, and why now in the 2020s, professional speculators like Paul Tudor Jones believes both gold and perhaps, according to him, the potentially faster horse, Bitcoin, stand to perform very well in the months and years to come. As mentioned late last week on May 7th, 2020, Bloomberg broke the story that Paul Tudor Jones and his Tudor Investment Fund have recently purchased a low single-digit amount of Bitcoin. Here he was after the following weekend, this past Monday, talking about some of his reasonings. This footage is courtesy of CNBC.
For a long time, you were a skeptic of Bitcoin and some cryptocurrencies, but you recently appear to have changed your mind about that. What happened?
Well, COVID happened, and the great monetary inflation happened, and that made me begin to think about how do you want to be positioned in your portfolio going forward. So that's really what tripped my interest in Bitcoin. And you have to realize, if you just think about, say, Bitcoin versus cash, right? Bitcoin when I think of stores of value, I think of it four ways: purchasing power, trustworthiness, liquidity, and portability. That's kind of the categories I put it in. So when it comes to trustworthiness, Bitcoin's 11 years old. There's very little trust in it. We're watching the birthing of a store of value, and whether that succeeds or not, only time will tell. What I do know is that every day that goes by and Bitcoin survives, the trust in it will go up. If you take cash, on the other hand, and you think about it from a purchasing power standpoint, if you own cash in the world today, you know your central bank has an avowed goal of depreciating its value 2% per year. So you have, in essence, a wasting asset in your hands. So Bitcoin, I think it's a great speculation. I've got something between 1 and I think just over 1% of my assets in Bitcoin. Maybe it's almost 2. That seems like the right number right now. It's not, for me, it's not the greatest. It's not the great cure for all the monetary ills, et cetera. It's a great speculation. That's what I would say Bitcoin is.
Right. Paul, do you see this, though, in relation? I'm thinking about tech stocks now, because one of the things we have seen even over the past 2 months is just the move towards virtual. Anything that can be done virtually has had great success, whether it be Zoom or any of the big tech companies in the Valley, because we're all able to do that virtually. Is that the way you see Bitcoin? And separately, do you own gold? I was going to ask at the same time.
I have assets in gold also. I think gold can go substantially higher. And yes, the digitization of the world clearly benefits Bitcoin. I mean, we wouldn't even be talking about Bitcoin if we weren't seeing first cousins like Venmo and a variety of other ways. My children don't even carry cash. They barely even know what cash is. So we're clearly digitizing the global economies. You've seen some countries do it explicitly, like India. You're seeing other countries on the way to do it, like China. So we're getting in an increasingly digitized world, and Bitcoin will be that much more accessible by that universe of people that could own it as a store of value. When you think about every bull market, every single bull market has one common thread: an ever-expanding universe of people who own it. So there's probably, the estimates are between 55 and 70 million people own Bitcoin. We really, if you're buying Bitcoin, your bet is that number is going to go to 120 million or to 200 million. And it's kind of hard when you look around and you see that the world's becoming increasingly digitized, not to think that the preponderance evidence at this point in time doesn't point in that direction. But again, when I think of Bitcoin, I look at it as one tiny part of a portfolio. It may end up being the best performer of all of them. I kind of think it might be, but I'm very conservative. I'm going to keep a tiny percent of my assets in it, and that's it. It has not stood the test of time, for instance, the way that gold has, which has been a store of value for 2,500 years.
Bitcoin day traders and headline-only readers may have not fully understood this news. Mr. Jones did not buy outright Bitcoin directly on the spot market. No, instead, like many successful and leveraged hedge fund traders, he likely used the CME Group's derivatives futures market for Bitcoin price action leverage. Interestingly, too, a little over a day and a half after Mr. Jones went public about buying Bitcoin futures, a few days prior to this past Tuesday's well-advanced hyped third Bitcoin halving date, it was not a surprise for anyone who's watched this market for a while that over the weekend, even with this supposedly bullish news that the price of Bitcoin did a 1987-style Black Monday-like crash, falling by 20% from Saturday through Sunday, dropping from around 10K to around 8K per Bitcoin. Currently, as recording this video, I think Bitcoin is roughly 9,500, so it's recovered most of that loss. Perhaps some Bitcoin whalers took advantage of those that were levered long. The concentration of this almost completely unregulated market remains extreme. Essentially, it's dominated by millionaire-plus hodler crowd. Nearly 60% of the notional value of Bitcoin is owned by less than 14,000 entities or individual investors. A similar point, but less concentrated one can be made about gold, as governments and their central bank partners own about own just over 1 in every 5 physical ounces of gold we human beings have ever mined. Investors, too, in the aggregate, between coins in drawers and gold bullion bars in vaults around the world, they collectively own another 1 of 5 ounces, similar to governments. The other 50% of gold's supply is roughly in jewelry, and another roughly 10% is split up in electronics, and people's mouths, and increasingly in high-tech applications. But we digress. We want to finish this video regarding some of Paul Tudor Jones's long-term views for both asset classes, gold and Bitcoin, highlighting some of his words, charts, and points of Tudor Investments' recent letter called The Great Monetary Inflation. Before we begin, just know I'll leave a Twitter thread link in the show notes so you can read all 10 pages if you'd like. Here I'll highlight some of the many prescient points contained within this research and perspective. The Great Monetary Inflation. COVID-19 is a one-of-a-kind virus that has triggered a one-of-a-kind policy response globally. The depth and magnitude of the economic drop-off took modern monetary theory, or the direct monetization of massive fiscal spending, from the theoretical to practice without any debate. It's happened globally with such speed that even a market veteran like myself was left speechless. Just since February, a global total of $3.9 trillion, 6.6% of global GDP, has been magically created through quantitative easing, and we are witnessing the great monetary inflation, an unprecedented expansion of every form of money unlike anything the developed world has ever seen. Global debt was very elevated entering the pandemic, and this monetary expansion is funding additional large debt creation for now without provoking the disciplining response of rising market yields. So far, the result has been asset price reflation. A large demand shortfall will prevent goods and service inflation from rising in the short term. The question is whether that will be the case in the long term, with a central bank whose central focus will be repairing the worst employment crisis since the Great Depression. One thing's for sure, there will be many assets that will move as a result of this money creation. So what is an investor to do? Traditional hedges like gold have done well, and we expect investors to continue to seek refuge in this safe asset. One thing I've learned over time is the best thing to do is let market price action guide your decision making, and then try to understand the fundamentals as they become more evident and comprehensible. Quite often, how the markets respond will be at odds with your priors, but remember, the P&L always wins in the long run. And with that in mind, in a world that craves new safe assets, there may be a growing role for Bitcoin. The issue is whether a large monetary overhang in the recovery phase will eventually stoke consumer price inflation. To answer that question, we need to ask how reasonable is it to expect that in the recovery phase, the Fed will be able to deliver an increase in interest rates of a magnitude sufficient to suck back the currency it easily printed during the downswing. The current Fed leadership has made it centerpiece of its new monetary policy framework to do whatever it takes to overshoot the inflation target in the recovery phase. This is a risky strategy. If the Phillips curve is truly flat, it requires a large increase in interest rates to bring inflation well under control. But a more levered economy is also one that does not digest interest rate increases well. So when the time for liftoff finally occurs, any hiking cycle is likely to be delayed and unambitious. Furthermore, the risk of a complicit, politically appointed central bank chairman cannot be easily dismissed, given that central bank independence is no longer a sacred cow. High debt accommodated by money printing is difficult to banish. Inflation expectations could one day respond to this reality. It's the risk of fiscal dominance that makes the current GMI potentially inflationary during the next cyclical upswing. After all, fiscal dominance was a key reason for inflation to flare up in the late 1930s and the 1940s, when the Fed was strong-armed to keep rates low and to monetize Treasury debt issuance well beyond the economic recovery phase. There are other reinforcing considerations to fear a resurgence of inflation down the line. The virus has exposed the vulnerability inherent in global interdependence and stoked tensions between the U.S. and China. And there may come a tipping point when a breakdown in global supply chains spills over to goods prices, undoing 2 decades of disinflation attributed to globalization. Many of you know my fondness for analogies. Bitcoin reminds me of gold. When I first got in the business in 1976, gold had just been productized as a futures investment, like Bitcoin recently, and had enjoyed a heck of a bull market, almost tripling in price. It then corrected almost 50% in nearly 2 years, similar to Bitcoin's 28-month, 80% correction. You can see the similarities in the two charts below. But in the case of gold, it was a tremendous buying opportunity as gold went on to more than quadruple past that prior high. The red line in the chart below is where we might be in Bitcoin today. Speaking of gold in a low carry world, gold remains a very attractive hedge against the great monetary inflation and hedges against other risks clouding the outlook, including a renewed flare-up in the China-US relationship where financial sanctions could eventually be used in a brute force decoupling. How far can gold rally from its current price? A simple metric based on the ratio of the value of gold above ground to global M1 suggests gold could rally to 2,400 before it reaches valuations consistent with the lowest of the three peaks in the valuation metric, and 6,700 an ounce if we went back to the 1980 extremes. One thing is for sure, these are going to be incredibly interesting times. And just one final note, he mentioned that the 1980 was extreme. There's nothing extreme about having the gold that we officially claim in our U.S. gold reserves backing the currency that we've issued. That's what we call a gold standard. And we were on the gold standard longer than we've been on a full fiat currency standard throughout the entire history of the United States. So it would actually be more reasonable in terms of our history. Yeah, of course, it'd be outside of our lifetimes, but if you look at the entire swath of our time, this would be the normal actual case and scenario. We hope you enjoyed hearing from billionaire Paul Tudor Jones on his gold and Bitcoin takes for the 2020s. To see how we too came up with a long-term gold and silver price forecast using the rapidly expanding M0 fiat US dollar currency supply, stay tuned for the end of this video for that hard-hitting 10 minutes of insights. That's it for now. Much love to every one of you out there. If you enjoyed this content, be sure to give our video a thumbs up and perhaps share it with those you love. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.